April 8th. Happy April 8th, guys. President Trump signed 2 weeks truce, suspending the war action in Iran. Iran, in return, should give us passage to us and the entire world Strait of Hormuz. What happens after 2 weeks, nobody knows. Even today, from what I'm reading, there is no safe passage of the oil tankers during the truce. We're living in uncertain times. Uncertainty is the enemy of all markets. Anyways, a quick economic update. Let's dive in. So we have war in Iran. Lots of uncertainty. We don't know when it's going to be over. Oil prices were almost double of what they were pre-war. Historically, when oil prices double, markets drop by at least 20%. Almost always we're going to have a recession. Okay, it's a temporary thing, hopefully, but nobody knows what awaits us next. War analysts, even before the war started, they said there's no way without boots on the ground. You bring boots on the ground, it's going to take years. Again, when we understand what's happening, we can budget for it, but all the money are in sidelines. There's no way people are investing in stock market, because we don't know what's going to happen tomorrow. So there's a lot of money on sidelines. Inflation. Oil leads to inflation. Higher oil prices lead to inflation. Your grocery shopping, whatever you pay at the pump, it changes the dynamic of what cars you buy. Gas was cheap. You guys were back buying F-150s. Today, you're going to be buying more Teslas. So inflation is really a risk if this drags on, the high oil prices, which may lead to a recession. It's too soon to talk about it, but yeah, if the war is not over, the oil prices stay high, they don't make some kind of a deal on safe passage of the oil tankers, there's a high probability of recession. Interest rates, I talked about it for years, but it's really pointless because every tweet from the president changes the dynamic. We don't know the game plan, and we don't see neither is Federal Reserve sees what's the next step, so we'll monitor the situation closely. But as far as look at it from this perspective, if we have an inflation, asset prices should rise. Right? Real estate prices should rise. Okay? If we have a recession, the Fed will more than likely lower the rates, or the rates, at the very least, the mortgage rates will not be hiked. Okay? So, we're risking deflation, but, that's a little bit complicated. But we hit a recession, we're going to see lower interest rates, good for real estate. If we see an inflationary periods are good for real estate. We don't have enough inventory in the market. People are sitting on 2-3% interest rates, they're not selling. We don't have enough inventory. In commercial real estate, there is no transactions because everybody's waiting for this and this, right? Everybody's waiting for the war to be over and some kind of a certainty on interest rates, because the tendency, the trajectory of interest rates was down, okay? So there's a lot of money on the sidelines. As far as the real estate prices and activity, everything is interest rates. You're gonna see lower interest rates, you're gonna see a lot more activity, and you're gonna see a lot more transactions. Think of it this way, somebody sitting in a house with a 3.25% interest rate, 3.25, market rates are 6+ today, right? They need to downsize, they need to move for schools, they need to buy something bigger. Unless you have enough money to buy a second place, why would you give up your 3% mortgage so you can go get a mortgage at 6.5% or 6% rate, right? So you have this disbalance. The minute rates drop into low fives, people would be more willing to take that hit. Like you're planning to retire, you want to sell your big house, move to a condo. Your family is growing, your kids are school age, you need to sell your place, move to a different neighborhood. So a lot of this is not happening because of the family economy. So that's, again, we'll live in uncertain times. Things will get better. Wars will be over. Maybe one day, wishful thinking. And yeah, I'll talk to you guys next time. Thank you.